Hey guys, welcome again to another episode of the marathon class we were having. I'm sorry this video is coming very late. I don't even know how long it's going to last. My battery is very low, but that's not a problem. So we've talked about what are the stuff we've talked about? I think we've talked about liquidity, price cycle, market structure. So like I said before, when you're picking your POI, you actually start with liquidity. Where is the strong highs? Where is the strong lows? You find liquidity, and then the next thing is structure. And then after structure, you find the next liquidity to target. But most times, shouldn't actually be liquidity to target. Should be your own trading plan. You find where you are targeting or what it is that you are targeting. It's all up to you. So, anyways, that's by the way. So, the purpose of this class is just for POIs. How do you select your POIs? What do you look for before you select your POI? It's it's that simple. It's actually not that simple, but if you follow the videos we've made from the beginning of these classes, you should be here. I actually wanted to talk about the market maker series, but I think I've talked about those stuffs like the AMD. I even made models on them and all those stuff, so I don't think I will be talking about them. I'll skip it. If you are still confused about them or you still don't know about market maker series, you just go to YouTube. I think there are millions of videos on it on YouTube. Market maker series, you just see the AMD, that's accumulation, manipulation, distribution, price accumulates, manipulates you into the wrong direction, and then distributes, come back, tapping, and then that's just the AMD series. Then you have the market maker buy sell model, accumulates, rally, accumulates next time, manipulates, and then drops, distribute, drop, distribute, drops, distribute the last time, manipulates, then rally, something like that. Just we have the market maker buy sell model. We have the um what's it called again? The AMD and all those stuff. So you could just go and study them. So for today we'll be talking about IOF. IOF is institutional order flow. Most of you that study ITC, I don't know what he calls it. Is it IPDA or something like that? I don't really know. I have not studied ICT. But that's by the way. So what we are talking about now is the institutional order flow. So in the for institutional traders that we are, I wouldn't call this smart money what we are trading. I won't really call it smart money, but whatever it is, I will call it no problem. But then, as institutional traders, we are what are we looking for? We are mostly looking to enter off prices where the institutions got involved. So, how do we know where the institutions got involved? How do we know institutionally funded zones? The market makers do not tell you where they enter the price, but then they leave a footprint. So what we are mostly trading is the footprint they leave behind. If you get the footprint right, you most eventually like get what it is that you are doing. Like for the past few hours or few minutes, I've been I think back testing on what's it called? Some strategies on trading. I was just mixing the entire strategies, picking a trade, trading it on gold. And as you can see, if you look at this, you will see the entire results as it was just back testing, loss, win, 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 and then missed trades, loss, win, BE, win, BE, win, loss, loss, win, loss, loss, win, loss, win. So all those things. What the reason why I'm showing you this is because even if you get the market maker series right, there are still possibilities that you will lose trade, like you pick the wrong ones. It's just for you to get your psychology right. There is no strategy that doesn't have losses. So if you understand that, and then you understand where the highs and the lows are, it should be good enough to go. So in a market structure, all we are looking to do is buy at strong lows and sell at strong highs. That is just all we are looking to do. Buy at strong lows and sell at strong highs. There is no two ways, or there is nothing else that we are looking for other than these two stuffs. So how do we know which areas are the strong highs and the strong lows? If you don't know, go back to the market structure videos that we've made. So the first thing you look for in market or price action is liquidity. Liquidity. Liquidity is the basics of what we look for in markets. So here is a rule. I'll just pin down the rule maybe for you guys right here. Make it bold enough so everyone can see it. The rules. The first thing is the first thing is where is liquidity? Then the second is what is the structure saying? What is structure saying? The third thing to look for is where is the strong high? Strong high and the strong low. Then where is the next liquidity to target? If you have an answer to these four questions, where is liquidity? For instance, let's start here. Where is liquidity? This is liquidity. This is liquidity. And then this is liquidity. Of course, every single high and low is liquidity. So I won't really be marking all of them. This is liquidity. And then this is liquidity. This is liquidity. Of course, every high and low is liquidity in markets. This is also liquidity. This right here, liquidity, liquidity, liquidity. So once you ask yourself, where is liquidity? You've marked every single stuff here as liquidity. All of them, liquidity. You've marked all of them. Liquidity, liquidity, liquidity. Ask yourself, what is structure saying? You don't need a miracle to tell you that this is a bullish market. Of course, price is making series of higher highs and higher lows. So you definitely know that we are bullish. This is a bullish market. Next thing, where is the strong highs and the strong lows? This is a strong high. Took out this high. This is another, sorry, strong low. This is another strong low. Took liquidity, broke structure. Inside, discount. This is another strong low. Took liquidity, broke structure. And then that is just it. Once you understand where your strong highs and strong lows is, you are meant to trade off those zones. If you are bullish without a market structure shift already, if we are bullish without a market structure shift already, then what happens? You buy. If we are bullish and we've had a market structure shift, that means the high have now turned strong high because it have broken a low. It's just that simple. So this is where the concept of order block comes into play. What is order block? Another block is those consecutive candles that took liquidity before breaking structure. Like from this point that you have this liquidity, those consecutive down candles, if they were consecutive, all of them, if there was another bullish candle before other bearish candles, you just refine it to the down ones. But those consecutive bearish candles that took out this liquidity, those are what we call order blocks. Other blocks are not just the last down candle before the down or before an up move. That's a lie. Whomever told you that, he's deceiving you. He's just trying to sell rubbish to you. Other blocks are those candles consecutive. You can refine it to the last one, yes, fine. But the reason why they are called other blocks is the fact that they took liquidity. If they didn't take liquidity, it is not order block. So once you see price make this movement, takes liquidity and breaks structure to the upside, you know that this is a strong low. Price is tapping into it. Once it's coming back into it, you look to trade off the other block. And the funny thing about it is, one characteristics they must have is that once they break structure to the upside or to the downside, sorry, once they grab liquidity first, they give out fair value gap. Like price is meant to leave that zone with impulse. Give up. It might be little, it might be small, or but the candles that follow have to be with impulse, impulsive candles. So in the purpose of this class, as we are talking about the institutional order flow, the IOF, right? The IOF. Should be talking under them. We should be talking about the order blocks, the breaker blocks, and then the rejection block. And then we should also talk about inefficiencies in price action in EA, which includes the fair value gap. Of course, we all know about what fair value gap is and the high volume imbalance. These are just, I will only talk about the high volume imbalance in this and then before we go into example so you understand what to do and what to look for when you are picking your zone. So I won't talk about fair value gaps. Everyone knows about fair value gaps and how to use it. So I will literally skip it. I've talked about it many times. Imbalance. Even the first series of videos I made, I talked about fair value gap. So under this inefficiency in price action, we should be talking about the fair value gap and the high volume imbalance only. So for the fact that we know what order block is right now and what to look for before we pick it. So what to look for is first, where is liquidity and what is structure saying? The structure is bullish without a shift in market structure. Fine. We go bearish. We still continue bullish. But if it has produced a shift in market structure, we know that our bias is now turning from bullish to bearish. But then before that shift in market structure, was there a liquidity grab? If that's it, you know that you have another block there. If you've studied the algo concept or whatever he called it algo, I think algo condo or something like that. I can't really recall. So once you've understand what where liquidity is that have been grabbed or the ones that have not been grabbed, and then you understand what structure is saying, and then you understand where the strong highs and the strong lows are. If you get those three stuffs right, there is 80% chance that your entry in the market or that trade you are about to take will be successful. 80% chance. believe me, there will be 80% chance that it will be successful. The important things about market is not always the stuff you see on YouTube. Of course, if those vital informations that actually are meaningful is shared publicly, how will the banks make money? If anybody tells you that your strategy doesn't work or that SMC is this, SMC is that, it's probably because they themselves failed with it and they want to sell you their own courses. See, there is no holy grail in trading. There is none. Absolutely none. Everyone trades what works for them. I'm telling you what works for me. If you see my zones, you normally see me mark out something like this. I'll call it either a pool of cash, I'll call it either I'll put it dollar signs to show you that this was liquidity grab. Sometimes they still fail. Of course, they still fail. It's not because I was wrong or I was right. Because that's trading. It's how it is. It is what it is. That's trading. Sometimes you get it right, sometimes you get it wrong. It still doesn't change anything. If it fails, you just dust yourself up and then wait for the next one. It's just that simple. It's not too like the AUD USD today I shared. It failed. Did I kill myself? I didn't even take it myself. So those consecutive candles that took liquidity before a shift in market structure or before a break of structure, those are what we call order blocks. But for the case of precise entries, we refine it to that last candles, to the last one. We refine it there so that our risk or our stop loss will be small. Now, this happens in all time frame. I'm going to take this out. This actually happens in all time frame, every single time frame. Once you get that consecutive candles that took liquidity or that takes liquidity from the market, price must tap back into that candle. For the purpose of this class, let's just do it in such a way that we have this move to the downside and then we have this. Now, this was liquidity. Of course, we know that this high was liquidity. And then this was a low. And now price have now taken this liquidity and then shifted. So what happens is that those consecutive candles from this point to this point, they could be one, they could be two, they could be three. Those consecutive candles that took out this liquidity right here, those are what we call the order blocks. And in 80% of the cases, price must tap back into it. It could tap back into this one or into the last one, whichever one it wants to tap, and then it continues going down. So this is where and how we pick the POIs that we trade from. The POI you are picking have to have two things. First is that it have to have taken liquidity itself. And then secondly, it must have inducement before it. So that when price is coming back, price will see liquidity to grab before tapping into the POI. Of course, price is always seeking for liquidity, nothing else. There are no two ways about it. So once you get a scenario like this, the next thing that you should be looking for is after this liquidity grab, the candles that comes or produces the shift must come with displacement. That's fair value gap. It must leave fair value gap. It has to have fair value gap. Most times, it's not always necessary, but to be on a safer side, it has to have fair value gap to be on a safer side. Trust me, it has to, because that fair value gap is what tells you that yes, this movement was produced by the banks. Like it was an institutional move. They did it. The institutions produced it because so retail traders like me and you, we can produce such impulse. So that impulse is what tells you that yes, they have been here, they were here. So this is the footprint they left for you and all those things. So these are the conditions for your order blocks. You could call it anything you want to call it or target anything you want to target, but that is just it. So the next thing you should also look for is breaker block. So what qualifies breaker blocks? Breaker blocks have almost the same thing as other blocks, or let's say SND flips. But I've talked about the SND flip, so I will not be talking about it here. So breaker block is once price mitigates a strong high or a strong low, what happens is that it breaks, or to show you that yes, the institutions were involved there, it moves with so much impulse, like a very high impulsive candle in such a way that that impulse breaks the last demand zone with with force. Let me just put it that way. With force, it just breaks through it with force. And once it breaks through it with force, this last, or the candles here, or what you would call the demand zone here, or other block that was here before this break, automatically becomes a breaker block. That means price have broken through it and will retest it. So this is what qualifies a breaker. This is what qualifies a breaker block. And for you to actually pick this as your breaker block, first, that breaker itself must be, if you are selling, it must be at premium. And then if you are buying, it must be at discount. Like for this one, it is not at premium. So I'll just shift it just to make everything clear, or maybe however you want to do it. But it must be at premium if you want to sell, and it must be at discount if you want to buy. That is what qualifies breaker block. Now, take this again. The candle that breaks this demand zone or whatever it is must be an impulsive candle. If you don't understand what I'm saying, go back to that picture I sent you guys on Nasdaq, where I said everything I'm going to be teaching about the next video is in this picture. It was on Nasdaq. Yes, it was when I changed my chart to blue and black. I sent this picture and asked all of you, please study this. Study it. That was what I said to you guys. Study it, that this will be the next class, what I'm going to be teaching. And then notice how each of the zones that I marked as breaker block, BB, notice how the candle that broke through that zone before the retest, notice how the candle was impulsive, impulsive candles. That is what qualifies. You don't want to see a price moving high, low, high, low, high, low, and then breaking this point and then coming down and coming back to it. There is possibility that it will wreck it. It will wreck through the zone and come back towards this point to mitigate this one before dropping. So this is how you use breaker block. I'm not saying you must trade every single pair or every single strategy. If you backtest breaker blocks and it works better for you, you stick to it. If you backtest rejection block and it works for you, you stick to it. If you backtest this other block that I'm teaching you and it works for you, you stick to it. If you backtest the FU pattern as I'm going to teach maybe after the next video, or after the next video, the third one, like the second video after this one, as I'm going to teach the FU, if you backtest it and it works for you, you stick to it. If it's fair value gap that you want to trade, back test it and it works for you as I'm explaining to you, you stick to it. If it's high volume imbalance, you back test it, it works for you, you stick to it. Like fucking stick to something. One, just one. You don't need to like, okay, this one is breaker, the other block have been mitigated, let me go to breaker. No, it doesn't work that way. Stick to one thing, one. So that when it fails, you know, yes, you obeyed your rules, you followed your pattern, you followed your plan. It was just price doing what price does. Just that. And then stop all this playing around with price and all those stuffs. Stick to one thing, just one, one. Or maybe you could stick to two, it's up to you. So once this happens, you know that this is a breaker. That is just it. Then for rejection blocks are almost the same thing as other blocks. So it was actually rejection blocks that I was going to say that it's the same thing as other block, but I mistook it for breaker blocks. So what do you call rejection blocks? Rejection blocks are what we call hidden order blocks. They always have very long wicks. Now from this point, let's assume that this candle was here. This candle was what cleared this liquidity right here, and then price rejected. Immediately after taking out this liquidity, price rejected. This move to the downside, this long wick means rejection, of course, if you studied candle pattern and all those stuff when you started trading forex, candlestick patterns, this inverted hammer or something. You see this rejection right here is what we call rejection block. Price will most likely tap into it. If you notice my FU pattern, it's the entries are mostly at the beginning of this week or maybe at 50% of it. Price will most likely tap into it and then reject back. That is just rejection block. There is nothing else. It plays the same role as fair value gaps. Sorry, as other blocks. But then the only difference is that we are using the wick, not the candlestick bodies. That is just it. Then if you talk about inefficiencies, like sorry, I'm going to show examples and after a while. If you talk about inefficiencies, inefficiency in price action is what we call imbalance. Of course, you all know about imbalance. I'm not going to talk about it. So, what differentiates high volume imbalance from fair value gaps? We all know what fair value gap is. But then, if we have a down candle like this, two bearish candles like this, two impulsive bearish candles, let's put it that way. Of course, they have to be with impulse, like two long bearish candles like this, two bearish candles like this. I'm sorry, I didn't prepare all these things before this class. You see this point that both of them met. Notice something, it has to be with impulse. You see this point that these two candles meet. There's a lot going on here. This is what we call high volume imbalance. If price was going down, there is possibility that it will tap into it and continue going down. This is the first case of high volume imbalance. The next case, the same thing, a long bearish candle. But then after it, you now have a very small bullish candle. So I'll change to green, bullish candle. And then you also have the next long bearish candle. I'll change it back to red. Of course, they will all have wicks. weeks, weeks, and all those stuff. Now, this particular candle right here, this one, is also called a high volume imbalance. This particular candle, and if you studied SND, this is exactly what we call a drop base drop. So, this is the third form of high volume imbalance, a second form. And then the third form is when you have two impulsive bearish candles. And then when this one closed right here, when it closed right here, that is where this one is supposed to open. But for some reason, this one opened with a gap. This gap right here is produced due to the volume that the market was moving with, the impulse. So this gap in here is also what we call high volume imbalance. So most times price will come back to fill it. And in most cases, this move that we have here or these moves, if you check them on lower time frame, it will look like this, something like this. It will look exactly like this. That is why we choose them in trading sometimes. So we've covered other blocks and how to pick them, rejection blocks and breaker blocks. And now we've covered HVI, that's high volume imbalance. So where do we find them in the market? They are actually in every single time frame. Every single time frame in the market, we can find them in every single time frame. If you check right here, we have this impulse, sorry, this liquidity. This is Euro USD on the weekly time frame. We have this liquidity that price grabbed before a shift in market structure. So what happened? These consecutive candles that grabbed this liquidity, they started from here. This one started from here. These consecutive candles are what we call order blocks. But for the sake of clarity or for the sake of precisement, we refine them to the last candles. Maybe this or maybe this. Once this happens, price is definitely going to come back to tap into it. And then before it taps into it, it has to leave an inducement. It's just like that. This is weekly. And trust me, this happens on all time frames. Every single time frame, it happens on all time frames. This is weekly. From here, we go to 4 hours. From 4 hours, we go to 1 hour. From 1 hour, we go to 5 minutes. I want you to understand that other blocks happens in all time frames. If you look at this, this was liquidity that price grabbed right here and then produced a shift. Of course, it produced a shift. These consecutive candles up to this point that grabbed this liquidity are what we call order blocks. All of them right here, these consecutive candles, these three right here, are what we call order blocks. Most times, you could actually let me highlight this. Notice something there is a very interesting case in this particular scenario. First, we have this other blocks that cleared this liquidity, and then they produced an equal high there themselves, right here. This is an equal high. And what happened? We have these candles clear it and then reject it. This is a rejection block, something like this. And what does price do? price taps in. It's just that simple. First, where is liquidity? This is liquidity. Structure, we are bearish. We were bullish, but we are bearish. We have a shift in structure right here. Okay. And then we also have liquidity grabbed and then a shift. So we are bearish. So what next? Other block. Where's the other block? Right here. They cleared liquidity, other block, rejection block, all of them inside here. What next? Inducement. Where is it? We have inducement here. And then what happens? You take your sell. You take your sell. There is no, this is weekly time frame. From weekly, we go down to daily. Even on bullish market structures, it should be doing exactly the same thing. Oh, wonder. Didn't get past here. Sorry guys, not my fault. That was that was when they started their business and they don't have the data past 2002. If this was FXCM, it will have the data and all those stuff. So once you have this scenario of you know where liquidity is, you know where your strong highs and your strong lows are, you know you've spotted your other blocks. There's nothing else to wait for. Just take the trade. It either fails or it plays out. It's just that simple. So this is other blocks, weekly time frame, and then we could dive into like I already have them prepared. Like we dive into 4 hours. And what happens? What happens right here? What do we see? We have this liquidity, equal low, equal low liquidity, and then price taps it out. Also tapping into this demand zone. Of course, you know we are bullish, but we are retracing. We have this equal low, price taps into it, and then we have this shift in market structure right here. A shift in market structure. So what happens? These consecutive candles that clear this liquidity is what we call order blocks. All of them. These consecutive candles that clear this liquidity is what we call order blocks. But for the sake of anything, you can refine it to this last one, or you could even refine it to this rejection blocks. Of course, you see how many times price was rejecting after tapping into this zone. Rejected, rejected, rejected to show you that it wants to go up. And then once it happens, you have to have fair value gap, just like this little fair value gap here. This very small one right here. And all those stuff. Maybe lower time frame, you could see other fair value gaps. It just follows that pattern, that particular scenario, liquidity structure, liquidity grab, and then shift. And then what happens next? You wait for other blocks, and that's it. Price just taps into it, and it keeps going up. Once you get it right, these are the type of entries you will have, like just price touching it and then going up. I've had many trades like this. Once I say it, I'll say, yeah, I got it right. It's just that simple. Just that simple. Very, very simple. This is 4 hours. Could go to any other time frame. 4 hours. I have this picked out. Like I just opened USD card. I haven't even traded USD card for a very long time. Just opened it today. I said, I don't know I want to use Euro USD for this back testing. Because everyone when I say is because Euro USD is something you trade every time or something you always with. I can't even remember the last time I made a setup on USD card, even though it's one of the best trading pairs because it respects analysis so much. It respects analysis. So This is another case, 4 hours. Maybe this one still has the same USD card. So okay, for this one is QM. This will be in the next videos. In the next video that I'll be teaching. So very interesting scenario right here. I don't actually think this was okay. We have this liquidity grab right here. This liquidity grab, and then we have this shift right here. Price have shifted with impulse, great impulse. Price have shifted with impulse. Now, I wouldn't really enter off this breaker block because price still needs to mitigate this strong high, because this is a strong high that produced this impulse. If you notice something, I think maybe this was actually a setup on the 1 hour time frame. I don't know where I made this setup, but wherever it is that I made it, this was still a case of rejection blocks. Like I said before, price have grabbed this liquidity and then to the upside. I don't even know if this played out. And then also left impulse. I can't remember. I didn't see this. Of course, it did play out. So what happens? Let's go back to the 4 hours time frame. So what happens after this is that once you have this scenario of where liquidity is, we are bearish, price is retracing. Of course, this should be inside premium. This should be inside premium. Of course, towards our golden zone. Golden zone. So we have this shift in market structure right here. So what happens? This is what we call the order blocks. Everything here, you can refine it to this one, all of them. It doesn't matter. You could refine it to everything here and take your sell. Sorry, take your sell. Take your sell. There is no two ways about it. And what happens again? Notice that this particular scenario also grabbed liquidity. This candle grabbed this liquidity, and then we have this rejection block right here. Rejection block. This is on the 4 hours time frame. Yes, liquidity grab, rejection block, liquidity grab, other blocks. So to they qualify, take your sell, your stop loss below, and then you target the next liquidity. Of course, this one, the next liquidity, this one, and then you can also take another buy from here because this also meets your criteria. Liquidity grab,
You pay me. You mean?
oh, this was actually a moving market. You could have targeted this fair value gap or wherever it is that you wanted to target 1 to 7, 1 to 8, and all those stuff. This is 4 hours time frame. 4 hours. You could go to lower time frame, maybe. It was actually on a buy on gold. Oh, my system's battery is very low, but I think I'll just rush this and round it up before it dies. What happens? We have this liquidity grab, rejection block, price taps into it. It just follows. This was exactly one of the reasons why I took that buy yesterday on gold. Liquidity, price grabs, and then shifts. What happens? Inducement, price taps into the zone. Rallies, 15 minutes. That's it, 15 minutes. Every single time frame. This is 1 hour. This was actually In 2021, 1 hour, we have this liquidity grab and then we have a shift. What happens? Of course, you could refine your other blocks to this point and then price taps in. It's just that simple. Once you get that idea, where is liquidity? Where is the strong highs and the strong lows? You are good. Find your liquidity. This is liquidity. Strong highs, strong lows. This was a strong low, yes, but this is also a strong high because grab liquidity and shifted markets. So what happens next? You take your sell there, and price now have taken this other strong low. This was a strong low. Price have taken it. So we know that our buyers have shifted from bullish to bearish, and price have also built up liquidity here. So what do you expect price to do in the long run? To come back into this fair value gap. And what does this fair value gap correspond to? This breaker block. Now notice something I say. That candle that breaks the breaker have to be with impulse breaker. I would definitely like shift shifting. Take my sell here, stop loss, be just above. Then target anywhere I want to target. Wherever it is, it's just like that. And let's see what price does. Taps in. Then it continues that way. It will. What happens next? This actually swept every single liquidity right here. And then where did it tap into? High volume imbalance. Remember what I said about it? The place where two long candles meet. These two long candles, of course, they are coming out from there. Two long candles, high volume imbalance, just taps into it and then drop. This then cleared out its entire liquidity, which served as an inducement for it. And where's the next zone? This one, other block. It taps in and it continued going down. Price will keep doing this. It just keeps doing this fair value gap or whatever it is that is tapping into. It will just keep going. You follow that institutional footsteps. You follow it as it's going. You follow as it's going. You follow until you get a valid shift in market structure. You follow. This is it. Very simple. Liquidity grab and then break of structure. This was the last point, other block or rejection block, whichever one you want to take. Price just comes in, tapping, and then go. It follows. And then we have this liquidity grab right here. And also, price might just tap into it and drop. And then that's it. Continue, but we have all these fair value gaps. We also have this high volume imbalance right here that price could react off from in the future, in the long run, or whatever it is. Then you have to understand like price builds up liquidity and then everything. See, this reaction is because of this high volume imbalance and all those stuffs. This was just it. This high volume imbalance. Although there was weak out from it, no problem. This was high volume imbalance. And what happens? Price then clears out this. There was this liquidity right here. Clears them out, all of them, and then drops. Could react off this high volume imbalance or this one, whichever one you want to. This is what we call institutional order flow. This is what is institutional order flow. Price didn't really tap in into this rejection block right here, but then at the end, it still tapped into this order block, which is fine. This is what you call institutional order flow. Following the institutional footstep, following what they are doing in the markets, following the structure, following liquidity, because that's the most important thing. Structure, liquidity, then structure, and then your zone. Strong high, where is the strong high, where is the strong low, and everything like that. It just follows that same pattern. Where is the liquidity, where is structure, and all those things. The zone should have inducement, and then once it have that inducement, they are good. It's just like that. Look at it. Liquidity grabbed, dropped, and then the supply or the high volume imbalance, everything just right here. Could even be the fair value gap. Taps in, and then you have this high right here, serving as inducement. It just follows that pattern. It follows. It just follows that pattern. It follows. This is 1 hour time frame. If you go to any other time frame, and then you see it happening day in, day out, day in, day out, day in, day out, day in, day out. It's just like that. After this liquidity grab, and then we have this shift right here. Notice what price does. Actually taps in into this other block of fair value gap. I think it actually tapped into the fair value gap. But now these have now made this a valid or a temporal strong low, because it grabbed liquidity, broke structure, price taps in, and then produce this bullish structure and all those stuff. So until price taps into another strong high, only then will we get a shift in structure, because we still continue going up. That's just it. Where is liquidity? What is structure saying? Where is the strong high? Where is the strong low? And then your other blocks. Thank you. The next class will be on what's it called? QM patterns. Like the QM patterns. Once I'm done with the QM patterns, I will then introduce the indicator I was talking about. And after that, I will do a video on the FU. And I hope I achieve all this before we start our challenge that we are working on. So I hope this video helps you, so you know how to pick your zones from now on. Thank you and God bless you.